Welcome back. So even as the Nifty is still about a couple of percentage points away from its all-time high levels, the Nifty Bank hit its all-time high levels just last week. Even in fact, as we speak, it's very close to those levels. And today, the Nifty Banking Index is up close to about 1.5%. Recent RBI data also shows that credit growth stands at a 9-year high at 15.5%. And this time, credit growth is fairly broad-based and not limited to a few sectors. JM Financial believes that this growth is likely to be, fairly healthy in FY23, and credit costs are likely to remain under control. Bhise, the banking research analyst at JM Financial, is now joining in to discuss about the sector and the outlook going ahead. Morning, and thanks so much for joining in. First, your thoughts on this credit growth that we're seeing. 15.5% is what the recent RBI data shows. Is this sustainable? What is driving it?
Yeah, hi, good morning. Growth has been largely driven by uptick in working capital utilization. Of course, retail lending has come back as we have moved to more BAU scenario. What has also helped is the fact that energy prices, which probably were looking pretty precarious in first quarter of this year, right now have come off from the highs that was the case earlier. So to that extent, demand impact has not been there. And banks continue to be in very good shape with respect to retail risk appetite. After 2 years of COVID, most of the issues are behind. So the ability to lend and willingness to lend has also gone up, and that is helping the overall credit growth. So we think FY23 should continue to see reasonably strong credit growth after a long period. At the same time, I would want to highlight that as we enter the second half, one will also be observant of how deposit growth shapes up, given that incremental LDR on a 12-month basis have moved to over 100% for the system. So we think that while demand has held up and is likely to remain healthy in second half, we will need to pull up deposit growth as well as a system, which then leads to the question that will deposit rates rise? We are of the camp that deposit rates should start moving up meaningfully in 3Q and 4Q.
What's your estimate of system-wide credit growth for FY23?
We think FY23 should end on a YOY basis at roughly 15 to 16%, primarily driven by greater working capital utilization. Capex is still some time away in our view, while signs are encouraging, though they have been there for some time. We have not seen a meaningful Capex cycle as an economy for the longest period of time. Though given the low leverage in the corporate sector, it is only natural to expect that they would want to expand capacities, given if some of these macro issues kind of stabilize or one has greater confidence on demand sustainability. So not so much of a FY23 story, probably towards second half of FY24, where you can see some bit of help coming from improving corporate capex.
All right. Hi, Samir. Good morning, and thanks for joining us. This is Pavitra. So something that we have been talking about is this retail loans really picking up and sort of, adding to the momentum. Do you think this is something that's likely to continue? And what would be your idea of the loan picture going forward?
Yeah, so I think it is sustainable. Mortgages have come back, or in fact, real estate demand continues to be well. Banks are in a strong shape to fund mortgages. At the same time, even on incremental basis, it makes sense for, given that rates have gone up. So mortgages is not as a low ROE product as it was, say, 6 to 12 months back on an incremental basis. We think real estate demand should sustain. That's the house view. Secondly, vehicle loans or auto loans, which were since 2018 had been a bit sluggish, those have also come back. So I think growth should sustain. For almost the frontline names in our coverage, we forecast almost 20% growth this year on the asset side.
By the way, you could see visuals of Finance Minister Nirmala Sitharaman, who's present at the Global FinTech Conference. So we'll be cutting across to get in the key statements from there. But Samir, back to our conversation. What we've seen of late is that deposit rates have gone up, but lending rates have not gone up in commensurate to the kind of increase that we've seen in deposit rates. Why is that? Is it because the competition on the lending side is too high? And what impact will this have on yields?
No, I think some bit of lending rate increase impact will be seen in 3Q, because lending rates were probably linked to the repo rate hike, while deposit rates are more market driven. So almost all floating rate product, especially mortgages and some of the external benchmark linked products, they were a bit too late to react. But now I think the increase is more than commensurate. Incrementally, we expect deposit rates to go up further in second half. Banks should be in a good shape to manage margins, especially in the current quarter as well. Given that if you see from the lows, repo rate is of 140 basis points. Large part of the move has come after June. So all of that will translate into your asset yields. Some bit of liquidity tightness is there, which is probably leading to a spike in short-term rates. But term deposit rates, we think, still have some room to go up, and that is needed for deposit growth to improve for the system as a whole.
All right, Sameer, just one final question before we let you go. Within the banking space, is it the larger, blue chip banks that you like, or is it some of the mid-cap names? And also just take us through your top picks in this sector.
Yeah, we have been liking larger names, though some of the smaller names have seen a good participation in the recent rally, and they still trade at reasonably inexpensive valuation. Our top picks among large caps continue to be ICICI, Axis, and IndusInd. Within NBFCs, we like Bajaj Finance as our preferred pick. So these are the top names. Amongst the smaller names, probably one of the new age NBFCs we have recently initiated is Poonawalla FinCorp. So these are our preferred plays.
Okay, thank you very much, Sameer, for